Hi guys, welcome back to the channel. I hope everybody's doing well out there. January 2022, we're here, and although it's a fresh start, it's no different in terms of our goals here on this channel in finding good, interesting companies that could potentially be good long-term buys. If you find value in this video or like the look of any of these picks, then please drop the video a like. I'd hugely appreciate it, and it'd really help out the channel in a massive way. Stock number 1 is a UK-based online food delivery company named Deliveroo. They operate in a three-sided marketplace that connects local consumers, restaurants and grocers with riders aiming to fulfil a purchase in under 30 minutes. It follows in similar footsteps to other big names working in this market such as the likes of Just Eat and Uber. Its revenue is split nicely at 50% between the UK and international, leaving plenty of room for a growth outside of the UK. The revenue growth in the last 4 to 5 years is nothing short of spectacular, with more than quadrupling, with revenue as of 2020 sitting at just under 1.2 billion. As mentioned, they do have tough competition out there. This huge revenue growth tells me that the food delivery market has the scope for numerous winners here. They do still lose money each year without making a profit as of yet, but a positive note for me would be that during this ramp-up phase, where revenue has increased greatly, they've started to improve their losses, where they broke a 3-year trend of widening losses. The balance sheet using its interim results up to June 2021 shows that they still have 1.26 billion sitting in cash with assets well outweighing liabilities, showing that Deliveroo have plenty of ammunition to fund growth strategies, perform acquisitions, or keep them running at a loss for a while longer. 2021 was a very up and down year for growth stocks across the board, and when you see the 52-week chart of Deliveroo, it's not any different. It had a fantastic summer period where it reached £4 before losing almost 50% of its value since September. Deliveroo doesn't trade at too much of a premium when you consider that they'll be taking in close to 2 billion in revenue this year and sitting on a 3.64 billion market cap with price to sales at only 2.61. I think this could be a great time to enter into this stock. Of course, there may be other reasons for this company selling off, such as underperformance or economic headwinds, so we'll take a look through their Q3 trading update to see what's been going on. They had 7.5 million average monthly users, 84% global rider satisfaction survey, 143,000 restaurant partner sites and 10,000 grocery partner sites. Orders are 75 million, up 64% year over year, and gross transaction value of 1.6 billion, up 58% year over year, gets us off to a very promising start. Deliveroo benefited hugely from lockdowns over the last year, as restaurants were either closed or at reduced capacity, resulting in restaurants that normally wouldn't offer takeaway services choosing to partner up with Deliveroo to bring in extra cash. Looking through the last 6 quarters, it's been continuous growth, but this has been the only quarter where it looks like things might slightly be slowing on an average customer basis, with it coming down from 7.8 million in the previous quarter to 7.5 million. It's still up 56% year over year and 142% since 2019. The average monthly order frequency is steady at 3.3, being pretty consistent with all other quarters shown here. These results, broken down a little bit further, looking into the UK performance, echoes that slight slowdown in orders dropping from 38 to 36 million and the gross transaction value coming down from its high of 921 million to 852 million. International results show the exact same theme here, so maybe with this cool-off period being reflected in these results, this could also be keeping the share price at a reduced level as the cycle of exponential growth has been broken. Deliveroo Plus was launched in September to partner with Amazon Prime, which all UK Amazon Prime subscribers can sign up for free Deliveroo Plus membership for a year with unlimited free deliveries on orders over £25. Although they don't provide the exact numbers, the growth rate has shown a jump up of over 120% in only a few months. They've launched Deliveroo Hop to enhance their grocery portfolio, where they've teamed up with Morrisons, who act as a wholesaler, allowing Deliveroo to benefit from Morrisons' established supply chain. It uses real-time inventory, eliminating the need for substitutions, which is a big plus for me. I've been using online shopping for a while now, and there's nothing worse than some of the substitutions you get from the initial order you requested. Q3 revised guidance is 60 to 70% GTV growth, which when you look at it from the original 2021 guidance is almost double that, and up from the first half year 21 guidance as well. Gross profit is to be pretty flat within a tight range of 7.5 to 7.75%, down from the 7.5 to 8% range given as with the original 2021 guidance. Using tip ranks, we only have 2 analysts covering this one, with 1 buy and 1 sell rating. Average price target is £3.5, which would give a very healthy return of 44% from current prices. Stock number 2 is a science and engineering company who operate within the defensive and security markets. They offer very similar services to the likes of Lockheed Martin and Raytheon Technologies, but smaller in comparison. Kinetic offer maritime and land, air, space and cyber security services to various partners around the globe. Revenue is mainly dominant in the UK, with close to 70% of revenue coming from the homeland, but a good and growing presence in areas such as the US, Europe and Australia. The share price for the year is down 16.5% and hovering around the 52-week lows. Market cap is around 1.5 billion with a trailing PE of 19.73 and also with a price to sales ratio of 1.14, making this one fairly to cheaply valued in my opinion. You do also get a very nice 2.6% dividend yield on top of this. The graphical representation from Yahoo Finance doesn't seem to be working in this one, but this is a pretty reliable, well-run company with good consistent growth from 833 million back in 2018 to 1.275 billion this year. The balance sheet is pretty solid too, with assets well outweighing liabilities, sitting on a healthy amount of cash with very little debt of 26.7 million, which is absolutely fantastic to see. The latest reports have some good news with it, also with a bit of a grey cloud hanging over the top of it. The good news being that orders are up 25% with a robust backlog worth 3 billion. The grey cloud is that profits have been dented to the tune of about 14.5 million due to a write-down on a complex deal, giving them profit of 53.4 million. They did also increase the dividend very slightly from 2.2 pence to 2.3 pence. Revenue is flat at around 600 million range, with operating profit and margins coming down as we mentioned. Net cash is at 140 million, up from 112 million last year. They have strong orders growth year over year with 21% total growth and 25% in organic growth, and this is after that complex write-down. Global products has been a huge growth driver, bringing in 67.2 million over the last year, with orders on the whole up from 561 million to 677.8 million. Europe, the Middle East and Africa have showed some impressive growth results over the last year through all various segments, with contract wins driving growth. Revenue up to 488 million from 425 million. Underlying profits up to 67.1 million from 57.9 million, with margins remaining similar at around 13.6%. And a funded backlog remaining close to 3 billion. Global products are actually down a good bit, mentioning that orders remain strong as they sit at 171 million, up from 159 million last year, but performance has been impacted in the short term due to delivery challenges in the US alongside the complex write-down. Net cash is down about 30 million from last year, but it's still solid at 139 million. This will allow them to invest in organic capabilities, complemented by acquisitions where it fits, maintain the necessary balance sheet strength and provide progressive dividend to shareholders, as well as returning excess cash to shareholders. The outlook for the year is to deliver mid-single digit organic revenue growth at circa 5% and underlying profit margin at the lower end of 11 to 12% expected range. The longer term outlook is the target of mid-single digit percentage compounded annual organic revenue growth over the next 5 years and operating profit margins to be about 12 to 13%. How will they complete this 5-year plan? Well, it's shown here that they aim to maintain their great working relationships with the likes of the UK, US, EU and Australia and grow organically, but also add in Canada, Belgium and Germany, where total revenue is expected to reach over 2 billion by 2026. 5 analysts in this one, with 2 buys, 1 hold and 2 sells, giving an average price target of £3.27 or 25% gain from current levels. And finally, on to stock number 3, which is Caretech Holdings. This company specialises in social care, offering adult and children's services as well as foster care. The adult area of the business provides care and residential services for adults with learning disabilities, individuals recovering from mental health disorders and adults with autistic spectrum disorder. The children's services is a provider of assessment, residential care and education for younger people with challenging behaviours, and the foster care segment provides mainstream and specialist foster care and small supportive groups across England and Wales for children with disabilities. Obviously such an important business, offering vital support for individuals and families around the UK. Caretech, as well as carrying out such vital care, is a really good company in terms of stock market performance and fundamentals. It's still up 11% from a year ago, but it's had a decent enough pullback from £7 to £5.75, pretty fairly valued in terms of PE ratio and price to sales ratio, and it still only has a market cap of 652 million, and they offer a very nice dividend close to 2.5%. Revenue and earnings have been continuing to grow even through the pandemic, growing from just under 200 million in 2018 to close to 500 million in 2021. Assets outweigh liabilities, which is a good sign, but debt has increased from 443 million. Some of this can be argued as being good debt, as this will be fixed to real estate assets which offer care. Caretech's 2021 highlights show resilience through the pandemic, with group revenue up 13.8% to 489 million, with EBITDA up 10.5% to 100 million. Earnings per share is up 13.3%, with property valuation also up 20%, and they've also increased their final dividend 8.6%. When we look through their track record of revenue, EBITDA and earnings per share, they've all been growing at very close to 20%, which is quite remarkable, and it's testament to this company's leadership and management teams. These are the financial results which I've touched on. Everything you want is to be increasing, including net assets, with net debt slightly being reduced by 3.8%. So this financial performance graph here, it paints quite a good picture that the company is performing the way that you would expect in a well-run company. Although Caretech specialise in providing care, their business model is heavily involved with real estate, and this can offer some real stability, knowing that they have a real estate portfolio under their belt. They've also been offering a progressive dividend each year, which this year has covered more than 3 times. They have the capacity to care for 2,000 children spread across 260 sites and 47 educational sites. 875 can remain in foster care over 11 locations, and they have the capacity to care for 2,104 adults over 213 sites, with all areas of care scoring 80% or above on good or outstanding care. Some of their highlights on the right hand side mentions the growth in capacity, active developments pipeline, high occupancy levels, strong referrals pipeline, and that quality remains high. The outlook remains strong, underpinned by a significant property portfolio, and the last point to mention that they will continue with their digital care pathway that complements their core services. On this stock, we've only got 2 analysts covering it, with 1 buy and 1 hold rating, with an average price target of £7.7, or a 22.8% gain from current levels. And that'll bring us to the end of this month's 3 UK stock picks. I hope you found some value in this video and possibly found some companies that you may be interested in. So thanks again guys, and I'll catch you all in the next video.